Hello and welcome back to our second lecture video dealing with Chapter 8, Accounts Receivable. In this video, we're going to see how does a company estimate its bad debt expense. So hopefully by the time you complete this video, you should be able to describe and illustrate both the percentage of net sales method and the accounts receivable aging method, which either one can be used for bad debt expense or used to estimate bad debt expense. So let's just jump right in. Okay, so we already established the fact that because of the matching principle and revenue recognition principle, and well, basically just because of GAAP, we need to match expenses with the revenue that those expenses help to generate, right? And we said that at the beginning of the period, we estimate the bad debt expense. There's two ways we can do it. First way, we're going to look at the percentage of sales method, right? And this allows us to estimate the bad debt expense as a percentage of credit sales for a given period, okay? So very important to recognize that the bad debt expense is a percentage of credit sales, not total sales, credit sales for a given period, okay? The percentage is usually going to be based on some historical credit loss that we had. So let's look at an example, right? Percentage of sales method. Let's assume that Scripps Company has 2016 credit sales of $700,000. Past experience says that 3% of these sales will not be collected, okay? So we need to calculate bad debt expense. Well, we take our $700,000, which is our credit sales, and we multiply it by 3%. That 3% is the, historically, we've always had like around about 3% uncollected receivables. So we just multiply them out, right? 700,000 times 0.03. So our bad debt expense is $21,000. We need to book this. To book bad debt expense, you debit bad debt expense, in this case for $21,000. We credit allowance for doubtful accounts, $21,000. What are we doing here? We are recording bad debt expense estimate for the year, okay? So what the company next needs to do is to monitor that allowance for doubtful accounts, right? Is it reasonable, okay? So the other method we could use is the accounts receivable aging method. And what this says is that we estimate the allowance for doubtful accounts as a percentage of our receivables that are still outstanding, okay? So the bad debt expense is then determined by an amount necessary to achieve the proper balance in allowance in the allowance account, okay? So here we're doing it, I guess, sort of backwards, right? We're saying here's our credit sales, 3% of these, 4%, whatever past performance dictates. We're going to use that percentage, multiply them out. That's the allowance, right? Here, by using the aging receivables, we're doing it a little differently, right? The bad debt expense is determined by the allowance account, or what balance do we need to achieve to get that balance for the allowance account, okay? So we'll see an example of this, but the allowance for doubtful accounts balance is computed by using that aging schedule on the outstanding receivables that's partitioned by the age of the receivables. What the hell does that mean? Well, here we go. So let's assume for a moment that we look at all our receivables, okay? And we say that, you know what, we have 0 to 30 days past due. That's $8,000. Well, actually, let's start current. We have 10,000 of our receivables that are current, right? Meaning they're within the 30 days, okay? because we offer terms, we'll just say 210 net 30, right? We want the balance within 30 days. How much of our receivables is past due? Okay, by how much time? Well, we're either past due by 0 to 30 days, we're past due 31 to 60 days, we're past due 61 to 90 days, or it's basically 4 months past due, right? Or I'm sorry, 3 months past due over 90 days, right? So we have the dollar amounts that are associated with those. Then we compute the required balance for the allowance for doubtful accounts using probabilities, right? What are our probabilities of non-collection? So let's just say that we have $10,000 that are current. We guesstimate, based on past performance, that there is about a probability of non-collection of 3 for those current amounts. That means that for that current amount, what's our allowance required? $300, okay? Look at 0 to 30 days past due. Well, $8,000 of our receivables are either 0 to 30 days past due. Again, historical probabilities says that it's about a 4. Okay, so what is the allowance required for 0 to 30 days past due? Well, it's $320. 800,000 times 4, or 4%, sorry, gives us 320, right? Same thing with 31 to 60 days past due. We have $5,000 of our receivables are basically a month to 2 months past due. Okay, about 5% of that historically has been non-collectible. Okay, so we're going to calculate 5% of $5,000, we get $250, and we keep doing that. So then we get our total allowance required. That's $2,370. That should be our allowance for doubtful accounts. Okay, $2,370. So let's assume that there's a beginning balance in our allowance for doubtful accounts of $400, right? We need to get our allowance for doubtful accounts balance up to $2,370, right? That's the desired balance that we have per our aging schedule, or using the aging method, okay? So that means we need to debit bad debt expense and credit allowance for doubtful accounts. What's the amount of the credit for allowance for doubtful accounts? Well, if we had a beginning balance of $400, we need to get to $2,370. That means that we need a credit entry of $1,970. We see at the bottom of the slide we're using the T account. That helps us to determine what that journal entry needs to be. Okay, so the required entry to get our desired balance is $1,970. We're going to credit allowance for doubtful accounts. We're going to debit bad debt expense. Okay. Tell you what, let's go ahead and talk about credit sales, specifically credit card sales, right? How do we account for those credit card sales, right? Well, we need to recognize that when it comes to credit card sales, the seller is collecting cash from the credit card company, right? The credit card company is that third party. They say that, you know what, we gave this person credit. This person owes us money for anything they charge. So what happens is, and think about, you go to Macy's and you buy a pair of shoes, you give them a credit card, right? Not your Macy's credit card, because that's something different. So you give them a Visa, Discover, whatever, any credit card, right? What happens is that the Macy's, the seller, right, receives cash from the credit card customer, or from the credit card, from Visa or MasterCard or whoever. The customer then has to pay cash to that credit card company, okay, which the credit card company then bills their customer, okay? So how does a credit card company make their money? Well, 2 ways, right? Number one, they charge us as the customer interest, but they also the credit card company, Visa, MasterCard, whatever, actually charges Macy's a fee each time a credit card's used. Okay. Now, businesses incur this fee because credit card companies provide a bunch of benefits to the seller. Think about it. What are those benefits? Well, number one, and let's look at it this way. We are Macy's, okay? Or let's just say we're a mom and pop grocery store, okay? If we extend credit to somebody, that means that technically we are financing their purchase, right? We have to wait till that company pays us or that person pays us till we get our cash back. So we have to evaluate the credit worthiness of all our customers, right? We have to deal with the fact that there's a chance we're probably not going to get paid, and we know that, right? We have some probability associated with that. The credit card company steps in and says, you know what, I'm going to assume all your risk. I'm going to determine which customers are credit worthy. I'll worry about collecting the money from that customer. Here's your cash. Okay. So that's the benefit really the seller gets. Okay. So let's look at an example of a credit card sale, right? A bank, some financial institution issues a credit card, right? So what happens? Well, cash is received immediately upon deposit from the credit card sales slips at the financial institution. So at the end of each night, a business kind of settles their account, right? They send electronically all the credit card sales that they had to Discover, all the credit card sales they had to Visa. They send it to the financial institutions. Okay. As soon as the financial institutions get that authorization, so to speak, the fact that somebody used their credit card, they then pay the seller. They pay us. Okay. We need to journal those transactions. How do we do that? Very easy, right? We're getting cash. We earned revenue. Perfect. They're not going to be equal, right? Let's say, for example, that we record credit card sales of $1,000, okay? However, the credit card company charges us 3%, okay? So we're going to debit cash for the amount that we receive. That's the credit sales minus the fee, which is $970. So we're going to debit cash for $970. We're going to credit sales revenue for $1,000. There's a $30 difference. What is that $30 difference? That's our credit card fees expense. Okay. When we come back in our next video, we're going to look at promissory notes. Okay. We're going to look at how do we calculate interest on notes receivable. And we're going to show the journal entries that we need to prepare to record notes receivable as well as interest. So tune back in for that one.